Unemployment remains at historic lows, and consumer spending is up, and yet there's no trade deal with China, and some say a recession is a possibility. Carolee McGrath sat down with Matthew Farkas, Vice President and Portfolio Manager at St. Germain Investments in Springfield, to take a look at the numbers and offer analysis and context regarding the uncertain road ahead. And full disclosure, St. Germain is a sponsor of WGBY's Murrow Gala event.
In terms of predicting recessions, it really is it's a little bit of an art and science. There certainly are storm clouds that are gathering that have us concerned. I think there's a number of things that we could talk about that potentially could push us in a recession. So, as investors, it is something that we're constantly monitoring and thinking about, and asking ourselves, do we need to make changes to portfolios in response to that, and anticipating some of this in some way.
And it certainly is a political issue. Of course, the White House says no, the economy is strong. Democrats, and of course, we're talking about an election coming up, saying no, that we're absolutely, heading in that area. It becomes a very big political thing, and I think that makes people a little bit nervous, and I'm sure some of your clients are in that position.
Yeah, that's certainly part of it, is that it seems everything these days are in the political arena. And so depending on which camp you're on, you're going to have a different perspective on where the economy is heading. As investors, we try as best we can to be as objective as we can and look at the data and try to really filter out what we view as just political noise that can be a distraction. So when we look at the world right now, there are a number of things that we're concerned about. I think that the main driver of the concern right now is the trade war that's going on between the U.S. and China. The U.S. is the largest economy in the world. China is number 2. So when two big economies are having a trade dispute, this really does impact the global economy. And we're starting to see some evidence of strain in the global economy in areas that are more exposed to trade. And globally, if we widen our lens outside the United States, countries that are more exposed to trade are really starting to show some signs of stress. A couple of good examples would be Germany and South Korea. Those are two economies that are more trade-driven, export-driven, and they're starting to feel the impacts of the trade war, directly. The United States is in a unique position in that, our economy is very large, and trade is very important to our economy, but it's less important to us than it is to other countries. And so in some ways, we've been able to mitigate some of the impacts of the trade war because we're not reliant as other countries are on trade. Where we're seeing it here domestically right now is in the manufacturing space. If we look globally, the manufacturing world is contracting right now, and that's because manufacturing is tied to trade. Manufacturing is this is not the U.S. economy of 100 years ago. Manufacturing is not a real large part of the economy anymore. It's 12-13% of our economy is based on manufacturing. So with manufacturing slowing down and contracting in some ways, that doesn't necessarily have the spillover effect to the broader economy that it would have, say, certainly 100 years ago or 50 years ago, even 20 years ago to some respects.
So what will be the impact if there wasn't, or if there is not a deal reached by December?
It's a cloud, a dark cloud overhanging markets right now. It essentially creates a lot of uncertainty. And so if you just put yourself in the role of a CFO of a major company, you don't really know when this is going to be resolved. And so that might delay new investment in a new plant or new equipment. And so these type of things, the cloud of uncertainty is impacting markets as well. And getting a resolution in the trade situation would alleviate that concern, and hopefully some of the impact we're seeing in manufacturing and trade would rebound, and the economy would overall would rebound up with it. But I wouldn't anticipate a deal being done on the trade war. It certainly seems from what I'm reading and what I'm talking with other professionals about this, it does seem like this is likely going to be with us for some time. So I think the big risk is that there's continued escalation in the trade war, so by the U.S. raising tariffs. In tariffs, a way to think about tariffs, essentially, it's you could consider it a tax in some ways. It essentially raises costs, and somebody has to pay those increased costs. So whether it's the companies importing the goods, or if they're able to pass that on to the consumer, raising consumer prices, it's a big risk out there.
Right. Up until now, have consumers really felt it? And consumer spending is up on the flip side, and unemployment is low. So if this continues, as you said, maybe into 2020, as a lot of people have said, when will consumers start to say, enough is enough?
Yeah, not to focus too much on the clouds that are out there, because there's a lot of good things going on right now. The unemployment rate is 3.7%. You have to go back to the late 60s to get a comparable unemployment rate. We're starting to see wages pick up. Wages are growing at the highest level in nearly a decade. The combination of both these factors is bringing people back into the labor force. So people that have maybe dropped out of the labor pool because they were frustrated because they couldn't find a job are now starting to get back into the labor force. So these are all good things.
So in the midst of all of this, the Fed's cut the rate, not as much as the White House wanted.
Right.
What do you advise, or how do you advise, your customers as far as investing? I mean, do they stay the course because this is politics and this is a cycle?
Yeah. So a few things there. So when interest rates move down, which they have, there's some good with it and there's some bad with it. I guess I'll start with the bad in that it does lower saving account rates, CD rates. So there's less safe income that's available that was generated a year ago or so. On the flip side, it definitely has positive effects in that it lowers interest burden. So mortgage rates have really come down quite a bit. Over the last about a year ago, we were approaching almost 5% on 30-year fixed mortgages. Today, we're about 3.7, 3.75 on average. That's a pretty big drop, over 1% drop in less than a year. And to kind of put that in broader perspective in terms of what that means for dollars, if you were buying a $200,000 house, putting 20% down, that 1% drop in mortgage rates, and we've had even larger than that, but just 1% drop, that leaves you with a little more than $1,100 extra in your pocket each year. So the reduction in rates definitely has in mortgage rates definitely has a nice impact in terms of housing, people having more money either to save it, invest it, or consume products, and we should see a boost in housing in response to that. In terms of investing in portfolios with this type of environment, the biggest thing to keep in mind is that it's I would say extremely difficult, if not impossible, to do two things. You got to get two things right. Is one, predict the recession is coming, predict the timing of it, and then two, predict the market reaction to that. I mean, you could know what's going to happen and not know how the market's going to react to it.
Right.
Sometimes markets can surprise you. I think a good example to kind of remind us of that is the election of President Trump in 2016. As I'm sure we all recall, it was nearly consensus view by both the press and markets that it was going to be a President Hillary Clinton. And generally speaking, and it was a big surprise election night, President Trump won. Generally speaking, markets don't like to be surprised like that. And if you remember that night, the futures were indicating the market was going to really plummet. But actually, we closed up the following day, and then we were off and running for a little while, which was a big surprise. So that's just a lesson there that predicting the future is a very difficult thing to do, and I would say in some respects it's probably impossible. So it really does pay to stick to a sound financial plan, have a long-term goal in mind of what you're investing for, and really do your best to stick with it. I would also say, you don't want to overreact to near-term noise. Things are going to come up that are going to be unsettling. Markets are going to gyrate. Overreacting typically does not work out for people over the long run, and so it really does pay to keep in mind of what your long-term goal is and try to remind yourself of that during tough periods.
And stay the course.
And stay the course as best you can. That's not to say that you shouldn't look at your investments and look at your overall risk level of your investments. You should honestly check in on your investments on not every day, but at least once a year. It's a good idea to kind of take a look at your investments and see what your goals are. Make sure that everything is in sync in terms of how you're invested, what your goals are. And I would remind people, The stock market can be volatile. I would say that the average person out there should not probably be all invested in the stock market because things happen in life, and it comes down to timeline as well. If you know you need funds, you have a fund for a wedding or a house down payment or whatever the case may be within the next few years. That pot of money should probably not be invested in the stock market because as we know, things can happen and they can take some time to filter out.